Hey traders, Nick Shaheen here, doing a little video on Amazon. I'm going to touch base a little bit on the stock market in general. So these are weekly candles, helicopter view. This is the S&P. Tomorrow might be a little different when we open. Amazon reported and it's not being well received. So we have higher lows knocking on a roof. If the roof breaks, they're going to overshoot a lot higher. It's too easy of a setup, so that's why I'm leery but optimistic. The buyers are definitely in control so far. This is a daily look, and this is a 4-hour look. Every candle is 4 hours here. Let me see if I can do this real quick. Boom, magic. Well, actually, it's not good. Okay, we'll go this way and go that way. The platform doesn't know how to reset itself with the drawings. Okay, here we go. Same chart. I just went out of it and back into it to bring my drawings. So you can tell I drew a box and we're still in it. So this tells me that push, pull, ping pong. They tried to break out, but it's not a coincidence that they're failing. Look left. Back in September. So now it's starting to look like an inverse head and shoulders, which are bullish, provided you take out the neckline. Otherwise, this may happen, all of that. But we take it one level at a time. Who cares what headline brings what line to be broken? Turn off the news, you'll be happier. Unless you're a news active person. Okay, so this video about Amazon, but I'm going to break it apart. We're going to say Amazon value, Amazon chart, Amazon catch the falling knife via trade with a mini lesson on that trade itself. Okay, everybody knows how to buy stock. You buy stock, you hope it goes up. Basically, it's a coin flip. You do some homework to give yourself some edge. I like to use options to sell puts and calls, or put spreads and call spreads, in order to give myself some leeway. And I'll explain in a second. So on to Amazon. So they reported, everybody's shocked at the level of profitability. I read some headline. The first headline I read, yeah, they got it softer, but the headline said Amazon falls 7% on because they missed earnings. Missing earnings is the least of Amazon's worries. Amazon is the ultimate growth company. I'm going to say it again. It's a startup. They go, what? It's been in existence for decades. Yes, but it never stopped starting up. It turns every year, every 2-3 years, it changes itself. It adds another venue to its top line. It went through AWS. It's going to be advertising next, and something else with a big question mark. We have no idea what it is. So as far as a company, I can't judge it like I would judge, say, something mature like Google, or maybe something a little more boring. Gosh, no, I can't think of anything. Anyway, pick a boring company, compare it to Amazon, you'd be making a mistake. I don't judge two companies the same way if they don't look the same. If somebody comes in and says, this is a startup, forget the ticker, just erase the name up here. There's a startup company that makes a lot of money, spends a lot of money, doesn't burn cash, can turn on the dial on the profitability dial up anytime they want. Would you invest in it? Heck, I would. Yes. But if somebody told me there's a company that makes a ton of money, is not growing, is just sustaining itself, you want to invest in it, then I'll have to ask, do they pay dividends? Otherwise, why the hell am I going to give it my money? Why would I want to buy it? Unless if it's going to make me money somehow, either via dividends or via capital expansion here. So this is a growth company. So I don't judge it with its bottom line. I judge it with its top line, because for as long as it's growing, Wall Street will forgive it. Now, I know Dean is listening and he's probably going, oh my gosh, what is he saying? I know it's true. So CMG, Chipotle, I hate the valuation. Okay, so expensive from a PE perspective. But it's not a company I say PE. As long as they're turning 11% comps for a restaurant consistently, that is mind-blowing. So it's going up. I wouldn't short it. That's my opinion. But valuation-wise, it is bloated. It's disgustingly fat. Okay, so same here, only less disgustingly fat, and I'll share it. So Amazon is 72 or 73 PE, 74 PE. This is trailing PE. So this is actual PE on results, not forward projections. So there's no speculation in it. This used to be 3 digits, and then high 90s for a while, and now in the 70s. 3.7 price to sales. Would you be shocked if I told you that this is cheaper than Apple? It is 3 times cheaper than Facebook, 2 times cheaper than Microsoft, just about, and Google. So it is not expensive if you consider its price, stock price, to the amount of sales it brings in. They have like 670,000 employees. It's a monster. So, and it still acts like a startup. It's just insane. It is a perpetual growth company. So I'm going to show you a few charts that are going to blow your mind, okay? So first of all, it dipped to $1,600 and change, $1,618 after hours. So let's say 1,600. I had a dip coming if it loses this level a while back. The dip, bump, and a dip. It dipped, it bumped, but it never dipped. So it dipped, it bumped, and it never dipped. And this is it. So this right here got traced out after hours. So it's going to look like this. Hey, we've talked about this. So a dip, and then a bump, and then a dip. So it may do this tomorrow. I don't know. I'm speculating, okay? But the point is that this level was known to whoever knows charts, and it's not a coincidental spot where I put it. This was a prior consolidation zone, okay? This was incorrect for everybody, the Christmas crash. Nothing now sets up as last Christmas. We have the Fed on our side. The China thing is going to solve itself sooner rather than later. If not, the companies have moved on. Brexit is going to end sometime. So, but mainly the Fed is on our side, and they are recommitted to inflating this world. All right, let's zoom out. This was 1 year worth of data. Boy, something smells good in here. Okay, so I'm going to take out all the drawings. This is 5 years worth of data. And that's not the mind-blowing fact. I mean, this is huge, right? Huge. It's a healthy stock. It's a healthy gazelle. If I'm a cougar and I get out and hunt and I jump into a herd of gazelles and I try to pick one to catch, I'm not going to pick one that's going to jump and leap at me. I'm going to pick one that's limping. This is not a limping gazelle. If I'm looking to short companies, why on earth would I want to pick on this one? This is not an easy short. It's left a lot of dead bodies behind it. How many? Okay, let me show you another chart. Okay, so this is Amazon still, right? I'm going to change it to a monthly chart. Boom. Okay, so this is the dot-com bubble. March, whenever dot-com busted, we'll see. Right here. Look at where Amazon is. It is 1,144% higher. So not only did it survive the dot-com bubble, it thrived. Okay, so I'm going to switch this same time frame to NDX, the NASDAQ. This is the dot-com bubble. Amazon was nowhere near it. So it's doing very well. That's a gazelle I don't want to short. Back to the weekly chart. This is where the levels come up. Somebody asked me, so how do I catch this falling knife? So the easy method of catching a falling knife is to actually buying a stock. A lot of smart people tell you wait for the 3rd day rule. The first day is going to get hit. It's going to dead cat bounce. It's going to get hit for another 2 days. They call it whatever. They have reasons for it, margin calls or whatever, settlement prices and all of that. Maybe they're right, but there's an easier way of doing it where I would leave room for error. So 1,600 is not that much lower from 1,750, in my opinion, and the scheme of time and space for Amazon. So let's say 1,600. That's where I had my red arrow. Okay. In fact, maybe I'll be able to do it. There it is. See it? Right there. I'm going to make it disappear again. All right, so back to my chart. That's the red arrow. So I know it was an important line because I drew down to it. This was the line that lost, but now it's going to be here tomorrow morning. Not a coincidental line. Look at this. This was R back in wherever, May of 2018. 2018. It hit the wall and it came back down. So this was a base. You see that little here? Base. Flag, whatever you want to call it. They rallied, hit a wall. Boom. They stumbled. Bears came out. They made their money from here to here. If they're smart, they got out. And then it went into second leg. These two legs are probably about the same size. So this is like an ABC push. I don't make this stuff up. There it is in print. Machines trading, AI, whatever you want to call it. They love to repeat the same stuff. So they hit a wall. They fell. They hit it again. They fought. They busted through it. They came back to it. They tried to hold the first week. The second week, this didn't close. These are weekly candles. They went lower, but they didn't close. They didn't close. One candle closed below. One candle right here. This one closed above, and then they finally fell apart into the Christmas crash. So only two candles, 3 candles below that line. But that was the Christmas crash where everybody hated everything. You remember how bad sentiment was last Christmas? And the Fed came out and pooped all over everybody to make it worse, to take us as deep as we can, and said, oops, sorry, didn't mean to do that. And now they're back on our side. So if the Fed said, no, we're not going to do this anymore, so I'm going to assume that this was wrong. So this is where I would sell puts in Amazon. Okay, this would cover the oh schmutz moments from last Christmas. That's my opinion. If I'm less aggressive, I can go out further in time and sell it at 900. I will find premium down there. So which brings me to the third part of this video. The first part was a little touch base on the whole economy. The second part on Amazon and how Amazon is cheap. Plug your ears, Dean. Okay, so it's cheap from a price to sales. It's cheap from a price to sales. As long as Bezos is leading it and they keep doing the same stuff they're doing, the PE is going to drop and the sales are going to grow. They're going to find another honey hole and they're going to be great. So yes, I would buy the dip in Amazon. How is up to personal preference. When is definitely up to personal preference. I'm going to tell you that tomorrow, when the stock dips at the open, the put premiums are going to be way up, and I'm going to show you something about it. So there comes the lesson of a put. What the heck is a put? All right, so in options we have contracts. Apparently this came out from the 1800s, from farming. People who farm needed ways to solidify things, so the idea of making contracts over things, over assets. So there are contracts out there for every week, for every level, for every major stock. Okay, so if somebody owns shares, if I owned 100 shares of Amazon, and tomorrow I watch CNBC and I hear some expert that freaks me out and says, you got to get out of Amazon at, it's going to zero. And say, I don't want to sell my stock, but I want to protect it. I bought it at 700, for example. So I'm okay coming down to 1300. But if it goes below 1300, because they see that number here, which would be a mistake, by the way. If I sell out of Amazon here, I'm making a mistake. I sell out of it here, not here. Okay. So anyway, but if they decide that this is where they want out, then this is what I'm going to sell them. That put right there. What does that mean? They buy a guarantee that if Amazon falls to zero, the guarantee will tell them you can sell your stock to whoever gave you that guarantee at that price. Let's say it's $10. It's going to be close. I'm just estimating. I won't know the number until tomorrow. So they can sleep well knowing that Amazon at 1300 or lower, they can turn around and exercise their right. They click a button, the stock disappears off of their books, goes on to my books at $1,300 per share. So if they do one contract and if the premium is $10, I don't know what it is. I'm making it up. It's going to be close. $1,000 goes into my account to make the deal. Like if they buy that put tomorrow, and then in the next few weeks, Amazon falls to zero, I wake up owning 100 shares of Amazon, and I would have $1,000 in my pocket. So what would have happened? He would have lost money and got out of the stock at 1,300 and lost $1,000 on top of it because he paid for the insurance. I would have not lost any money yet, owned Amazon, and I have $1,000 in my pocket to play with, which means that my break-even point is $12.90. because I bought it at $1,300, but I collected $10. So I have a $10 cushion to play with. Okay, so that's how a put works. So what does that look like? What are these puts you speak of? Okay, so this is a options chain, which is blank. It's Amazon. It closed at 1780. Okay, and I want to show you something. I'm going to go to today's contract, this week's contracts. This has 1 day on it because tomorrow, Friday morning, we open, and this is Amazon here, and it will have only that day, and then this contract just dies. But till today, whoever owned calls made 40% on their money just from today's action if they owned Amazon calls. The stock only went up 1%, but the calls went up 40%. I say this to make a point. Same for the puts. They lost 20%, even though the stock only went up 1%. Puts and calls, the options move. The valuation of them is on crack. So that's why you risk less to make a hell of a lot more. But time is against you if you're buying them. That's why selling them makes more sense for somebody who knows what they're doing. Okay, so back to the at hand. So tomorrow, the puts that I would sell would be somewhere in December, maybe January. Let me go to December just for round numbers. Maybe I'll go to January. So this has 85 days. This expires middle of January. So basically, if I sell somebody a put at 1,300, I'm going to go down to 1,300. Okay, so you can see they're cheap. They won't be this cheap tomorrow. Okay, so, but if somebody today wanted to guarantee their money at 1,300, they paid somebody $200 to guarantee 100 shares. And if in the next 85 days Amazon goes through $1,300, it only costs them $200 to guarantee all their shares below 1,300. Okay, so tomorrow I'm going to estimate that this is over $10. Okay, you think who would do that? 4,300 people. There's 4,300 open orders right here. See that number right there? So I'm not blowing smoke here. And today there was action on it. 29 of them did that. And see, they didn't pick any, this is the busiest one. That's because they know charts. They saw what I saw. Okay, so I'm not saying it's going there. I'm saying it's a meaningful level. Tomorrow, let's say this is $10, because that's the number I used. So if tomorrow somebody wants to open their insurance policy to protect their stock, it's like calling when your house is on fire. Oh my God, cover my house. Instead of waiting one more day to get more intelligence on it. So they would pay me $10 so per contract. That's 100 shares. So it's $1,000 that goes into my account. And basically, they click on this and say buy. And they say 1. On the other side, I would have said sell 1. My account grows by $1,000 cash. It's not an asset. It's like a liability. When you own a business, and you collect somebody says, come fix my water heater, and you collect $1,000, that's cash in your account, but it's a liability because you haven't performed the product or the service yet. Same here. If I'm an insurance company, I think they do the same accounting. So they collect the money, but they are performing the service as time ticks, and they're on the hook until the 85 ticks to 0. Like tomorrow, whoever had sold puts that are not going to be reached, anything below 1,600, that clock is going to tick 0. Whoever bought that insurance is going to go poof, lost their money. But that's okay. That's what insurance is for. So basically, I'm saying to Amazon, what is it today? Let's say it's $1,600 tomorrow. So $300 divided by $1,600, 18% price buffer. Amazon would have to fall another 18% on top of the 7% that is falling after hours for me to start get in trouble. Because if it falls that much, then I may have to own the shares. Really, they shouldn't give me the stock until it hits $12.90, because that's their break-even point. They pay $10 for the damn thing. So that is their break-even point, and that's my break-even point. Because let's say it falls to $12.95, and I wake up and the idiot gave me the stock. Like, what are you doing? So now I own it at $12.95, but I collected $10. So I'm up $5 a shares. So I wake up, $12.95, I sell it if I want to. I sell the shares. I keep his $1,000. I sell the shares. I made $5 a share. So that's why $12.90 is my break-even point, and it always boggles my mind how sometimes they act on early. Anyway, so that's how a put works. Somebody wants to buy insurance. Somebody does the homework and say, you know what? I like the way you drive. I like where you're driving, $1,300. If somebody says, hey, I want to buy insurance at $1,500. I say, you're too reckless for me. I don't know if I want to sell you $1,500. Why? Because I got to go to $1,500 here and justify, you know what? You know, we were at $1,500 just a few months ago. Nah, I don't want that drama. I'm going on vacation, or, you know, I just had surgery or something. So maybe I want lower. I want something less intensive. So, no, buddy, you go find another insurance company. He goes, well, how about $1,400? Would you sell me to $1,400? So I'll go to my chart. 1,400. Yeah, you know what? 1,400 sounds okay. If this candle is meaningful, I would take my chance on the Christmas crash. But if I really believe in my thesis, 1,400 may be okay. And I'll look at the premiums. They're not going to be $5 tomorrow. Whatever they are, say, okay, maybe I'll do the 1,400. But it all depends on personal preference. I know friends of mine that want to sell it in the money or at the money. So they'll go to 1,600. They'll say, you know what? The worst case scenario, they flashed 1,600. I want to sell that tomorrow. And so, but that's not me. I like low-key, boring trades. So out in time, lower down here. In fact, if somebody says you have to go on vacation, you can't look at any stock for a long time, and they'll say, okay, let me sell some Amazon puts at 900. Which means I want to own Amazon at 900 and I'll collect $200 per contract. And then the worst case scenario is for me to own Amazon here. All right. Anyway, that's a longer video than I wanted, but I think it's chock full of important information. Most importantly is the lesson on puts and how puts work for the buyer and for the seller. And this was real life discussion off of real life earnings from a real life company, Amazon.